everything is perspective, right? And I've been talking about this all week about the more ignorant we are about things, and I'm not saying that towards you, obviously, but the more ignorant we are towards things, the more things seem risky, right? And they seem negative because we fear what we don't understand, hate what we can't conquer. That's Nas, not me, but I like it.
I think on that one of particular segments, you all talked about hard lenders, hard lending. What's the difference between hard lenders and traditional lenders? Was that something that I even need to even look at this phase?
So traditional lenders would be conventional lenders. So these are, your Flagstars, your Quickens, your like all of these lenders that lend in the primary market, right, which are on conforming products. So typically it's going to be, FHA, they'll do conventional loans, right, with 5 to 10% down, VA loans at 100%. Those will be like your conventional primary market lenders. Secondary market lenders are your hard money lenders, okay? So secondary market lenders are your hard money lenders, and, they lend on distressed assets, non-conforming product. Because it's too high risk for banks to lend on distressed assets because the reality is they literally are using our money to lend on their stuff. But we don't have enough sense. That's why I appreciated what you said in your homework. But we lack the knowledge to go do what the bank is doing with our money, and they doing it every day. You know what I mean? It's kind of crazy.
About those hard money lenders, because you see the signs. I see the signs all over town, on the bus stops and all that. Are they? I guess I presume that they're dangerous, or like loan sharks, or like way high interest rates. Could you give us a little more information on what a hard lender, like their interest rates, or their don't mess with those kind of groups, or it's just a bad thing on TV that I see?
Everything is perspective, right? And I've been talking about this all week about the more ignorant we are about things, and I'm not saying that towards you, obviously, but the more ignorant we are towards things, the more things seem risky, right? And they seem negative because we fear what we don't understand, hate what we can't conquer. That's Nas, not me, but I like it. So what happens is hard money lenders, because of the volatility and the type of investment that they're making, they are forced to charge higher interest rates. So you may go to a traditional bank to buy a conforming product that don't need any kind of money put into it. They take you through this extensive underwriting process and give you a mortgage. Well, that's very low risk, which is why they can, charge you 3, 4, 5% interest rate on that, right? In a hard money lender case, you're going to buy this distressed, beat up property that they're going to give you 80, 90% of what you need to come in and purchase it and rehab it. You got to put tens of thousands of dollars in a rehab, and they're betting on the fact that you're competent enough to go do what you're supposed to do to get this thing to a place where it's going to sell, and sell for enough money to get you and them their money back. So absolutely, they charge a higher interest rate, right? And higher interest rate is relative, because this is why I keep saying we got to get proficient at underwriting deals, because regardless of what the interest is, you should always be looking at what is your yield on top of that interest. So if they charging you 10% interest for 12 months, right, and you plan on having this project done in 6 months, then you just account for the 6 months of holding costs. So if it's, $100,000 loan at 10%, and we teach you all this, right? Like, well, I'm gonna teach y'all now. You take the total loan amount, you divide that by 12, and then you multiply that by the interest rate. They give you your monthly interest payment, okay? And it's interest only. And so that's how you start to understand, okay, so if I got this flip and I paid 50 grand for it, I got a $50,000 rehab, my total cost is 100,000. The bank's gonna lend me, I'm just gonna say 100 for this illustration, right? They're gonna give me $100,000. They'll never give you all the money, but just rock with me for a second. And then they're gonna charge me 10% interest. So that's $10,000. You divide that by 12, and then all of a sudden you got your monthly payment of 800 and some odd dollars per month, right? Until you flip the house and get them their money back. So in saying that though, I would account for, there's $6,000 in payments. I would account for the $5,000 I'm probably gonna have in miscellaneous, right? And then I'm gonna account for, which is like my property, my insurance, my utilities, the upkeep, the lawn, like Damon asked about that, cutting grass through the process, all that. So I'm at like 5,000 for my miscellaneous. I'm gonna have like 6,000 for my payments, and then I'm gonna have whatever I owe them, right? Owe the lender. And so when you take that and you reverse engineer starting from where your ARV is and taking out your rehab costs, taking out the money that you got to pay the lender, and then you look at what's left, that's your profit. So the trick is, it's not to focus on how high the interest rates are, unless they're not competitive with industry standard, right? Short of that, your goal is to find a deal that outperforms whatever the cost of money is. That's the real game. It's not about how much the interest rates are. And yes, there are a bunch of scumbags out there, to your other point, right? But I didn't want to start with that because I want to more so educate you on the industry as a whole. And like any other industry, there's probably 10% of them that are great and about 90% that aren't so much, right? But we do need asset-based lenders in our lives if we want to go out and do the things that we need to do until we get to a point where we can start going to what's called family offices, which are like, private equity firms specifically in real estate. That's essentially what they are. But it's levels, right? At this level, you're gonna need asset-based lenders gonna be your best friend until you can start really getting more access to different types of capital.
A couple of things was on my mind, how you were talking about, the difference between assets and liabilities the other day. And then also how, to be efficient, we move with purpose. One particular move serves several purposes. So I was just wondering off the top of your head, if you had any ideas on how someone in my situation can collaborate with like family members or things of that nature to reduce our expenses, reduce our liabilities, and increase more of our assets.
It's funny, man. I promise you, this is just so crazy to me. So every day y'all ask me questions that's literally a part of the presentation today, right? Which is good. That means that we're moving in the right direction and everything is building on. That always does something for me, the realization of that. But before you would collaborate with other family members, I would say, in my humble opinion, I would say that you look at your current situation and see where you can start reducing your own liabilities, right? I'm one that believes, I don't think you can contract your way to wealth, right? I don't think you could just stop going to Starbucks and make your own coffee. Like, that ain't it. If you want to decrease your liabilities, you got to look at the heavy hitters. You got to look at, where do you live? Do you need to get out of that 2,000 square foot house and go get you 1,100 square foot apartment for a little while, right? Like, those are the ones, right? The car you got, do you really need that car? Those are going to be your heavy hitters. And if you can reduce those liabilities, then you could create margin in your monthly finances. And then you setting yourself up for a good runway, right? If you're willing to make those kind of sacrifices. And I would say I would start on an individual household basis before I start to collaborate with family or others on that piece. And I'm gonna actually dive into some practical steps on doing that today through the presentation. So great question.